welcome on into the show. We do have a show, indeed, Retirement Compass Radio Show with Stonebridge Wealth Systems. Jackie Selby speaking. I have Tim Kulhanek in the Lincoln office and Jeff Gove in the beautiful, new, not even decorated all the way, Kearney office. How are you both?
Doing good.
Good. What do you think, Tim? Kearney office?
Yeah, I mean, it's beautiful. I was so scared, I almost felt like I saw a shadow.
Oh, you're so naughty. We're working on the shadow issue.
Come on, Tim. If you watch it on YouTube, you will know what Tim's talking about. I do have a minor shadow behind me. I do feel like I'm getting sunburned by these lights.
Yeah, you have to give him credit because the shirt matches the hair, matches the wall.
My shirt is not brown, Jackie. Come on now. We're going there today, huh?
Oh, my, Jackie.
Hey, listen. Mr.
If anybody
Gove
knows of like some like just temporary color, like I'd love to go home with like dark brown hair to my kids and just see what they say.
See what they say.
What happened to Dad?
London might be freaked out, my youngest, but I got to make sure it washes out like right away because, yeah.
Well, you guys have seen those videos of kids' reaction when the dad shaves the full beard off? The kids just bawl. They just are like, Dad, where's my daddy? He doesn't have his beard.
Yeah.
We're here to talk about retirement and investments and all the things that go into what's going to make a wonderful retirement for folks. So I have a funny quote. I'm not retired. I'm a professional at doing nothing, and I'm great at it. You got to have a plan, though, to get to that point where you can just hang out. And you can help them get started. I'm going to give the phone number right off the bat. To call Stonebridge, it doesn't matter which office, use this number, 866-295-5146, 866-295-5146. Let's talk about this Edelman study that came out because only 12% of Americans feel themselves wealthy. Why do they feel that way? We're not talking about ultra wealth, Tim Kulhanek. We're just talking about probably safe enough wealth.
Yeah, so I think it has a few things to do with the fact that 58% of them, according to studies, say that you need at least $100,000 per year to not stress over basic expenses, and then a quarter believe that you need $200,000 a year annually to feel secure. And when you're thinking about folks that are retired and living on a fixed income, I don't have the exact data in front of me, but not a lot of them are pulling in a pension anymore, and so the odds of being retired and being able to consistently draw that type of income is fairly low right now for the average retiree. If you think about it, a lot of folks are getting Social Security payments somewhere in the range of, I'd say, like $2,100. The people we see, they draw early, maybe $2,100, $2,000 maybe, up to, if they delayed, around $4,000. But let's say the household income is $6,000 a month for Social Security, and that's $72,000. Well, if they're saying that you need $200,000, and we're not even looking at taxes yet, which is obviously a huge implication here, that's $128,000 that would have to come from your retirement accounts, right? Because $72,000 is coming from Social Security. You need another $128,000 in order to meet that $200,000 to fill that income gap. And if you're abiding by the 4% rule, that means you need $3.2 million in retirement accounts to be able to maintain that type of income. Now, let me just be very clear with folks. I, by no means, even close, think you need $3.2 million to be able to live a financially secure and enjoyable retirement. In fact, I don't have that many people that I work with, and we work with people on a pretty broad spectrum as far as income and resources go. I don't have very many people who are bringing in $200,000. Are there a few that happen to, kind of hit the jackpot from the fact that they have Social Security, and now with the Social Security Fairness Act, they get full benefits. They have maybe a military pension or a government pension of some kind on top of that through FERS, again, through the military, maybe VA benefits that are all tax-free, and they have like retirement assets because they had a TSP or a 403B or 401k. Yes, but that is the exception, not the rule. So really what it comes down to is why are people feeling this way? And I think a lot of it is misinformation. They think, and this is what we see too, right? Is people think they have to have this big number. I have to have $3 million. And really, your number is different than your neighbors and then the person across the street and the person down the block because everybody has a different, unique financial situation and goals and aspirations. And really what people are looking for, in my opinion, is peace of mind. And I think that's really what we should try to be delivering. We're talking about, hey, people are financially insecure right now, and we can hopefully, with this show and with the work we do in our communities, help alleviate some of that.
Most certainly. And again, the number to call if you'd like to reach out to Stonebridge, it's an 866 number, 866-295-5146, 866-295-5146. And the fancy new YouTube channel that has all of this content up there and going forward is Stonebridge Wealth Systems, right, on YouTube. Jeff, Stonebridge Wealth Systems?
Yes. Yep.
Oh, great. All right. So you can check us out there. We're going to have a QR code. I almost said a URL, but a QR code on the screen. You can just aim your phone at it. It'll take you right to the tax bill, stonebridgetaxbill.com. Or you could just go to stonebridgetaxbill.com to see how much you're going to be paying in taxes over the course of your retirement from your accounts. Isn't that right? Is that a fair assessment to say that's what the calculator does?
Yeah. So what it's looking at is all of your tax deferred accounts. So whether that's 401k, the TSP Tim was just talking about, your traditional IRAs, those accounts that you haven't yet paid taxes on. So the taxes are being deferred. You can plug that in there. It's really simple. It won't take you long, and it'll tell you what tax bill is actually going to look like for you throughout your retirement.
And Jeff, what do you think the greatest age of a client is to do some of the converting of those 401ks or IRA monies and to have the best benefit out of that conversion? Is there like an age group kind of?
There really isn't necessarily just an age group. I mean, for younger people, there's things that you have to consider. So I hope you don't listen to our show and hear, I should go convert all of my IRA without doing any planning, because you could get yourself in some trouble from a tax perspective. But it's more looking at how much tax do you want to pay? If let's say you do the calculator and you have $500,000 in your IRA and you do the calculation and it says over your lifetime you will pay $700,000 in taxes on that $500,000. That sounds crazy, I know, right? You're going to pay more in taxes than what you have today, but a lot of times that's what we see. And this is just an example. But if the alternative is you could pay $200,000 in tax over your lifetime, why would we not want to put together a plan that allows us to do that? That's what the tax calculator will do for you. Is it'll give you a starting point so you know where you're at. So then we can help you develop a plan of how to get you to keep more of your own money.
My goodness, yes. And the number to get started, if that's what you want, is to sit down in person, have a little visit, 866-295-5146, 866-295-5146. And Stonebridge has offices all across the Midwest. It's pretty easy to make it happen. Omaha, Lincoln, Grand Island, Kearney. Anything else I should know about?
Really, I mean, yes, we're located in the Midwest, but we help people across the country. I've got clients in California, North
Colorado.
Carolina, across the country. So technology is great. That's one good thing that came out of COVID is, a lot more people are comfortable with doing Zoom meetings, which we can absolutely do that too.
Yeah, that's fine. And you have clients who leave the Midwest during the winter and go elsewhere.
I don't know why.
Yeah, I can't imagine. But so tell me, how does that affect, say, estate planning or whatever? Say they have a house in Omaha and then they have a house in Phoenix. I mean, does this affect estate planning and taxes and stuff like that? You have to choose one residence as the primary? Tim?
Yeah, and I mean, Jeff, do you still have your house in Malibu, or did you sell that? No?
It fell off the cliff.
Just kidding. So it's San Diego? No. So it does impact estate planning for sure, and this is why we usually look at things like, what type of estate documents and estate strategy do you need to be using? A lot of people come in, they'll think, I need a trust because my parents had a trust, and so trusts are great, and therefore I need one too. And that may not be the case if you don't own additional properties. But then one thing you want to try to avoid is like ancillary probate. So if I have a property in Scottsdale and I've got a property in Omaha, Well, then if everything's will-based, if you will, it's going to go through probate, and I'm probably going to have to file probate in both states. And so if I've got it in a trust, I can potentially avoid that. There's some other strategies that you can do with like LLCs to try to help alleviate some of the hassle of having property in other states, because if it's in an LLC, it's not you own the LLC. The LLC itself owns the property. So those are some strategies. We work with our partners in the legal field. So it could be estate planning attorneys, and then we bring in the fold, somebody's tax preparer as well, to make sure that everybody's on the same page. It really is this personal CFO, where when you're working with Stonebridge, you're hiring us to make sure that the right players are on the field at the right time. I sometimes give the analogy that I'll tell people, hey, do you remember that year that Bill Belichick...
Boy.
What?
I didn't say a thing.
I saw your
My judgy face?
Yes, changed. Anyways, I think it was like 2011 or 2012. His, what would it be now, girlfriend was just going to her 8th grade dance, probably, final grade dance. Anyways, but that year during the Super Bowl, he decided that he wasn't going to put 11 men on the field on defense because he wanted to show how dominant they were. And so for the entire first half, they played with 10 men rather than all 11, to show that we could win with one hand tied behind our back. And I'll tell people, do you remember when he did that? And some people are like, oh man, I forgot about that. Well, you didn't forget about it because it never actually happened. You always want to have your best players on the field, no matter how dominant you are. Obviously, the most dominant football team to ever play college football was 95 Nebraska. I mean, can we all agree with that?
Oh boy.
Head shaking yes? Okay. So we weren't going to sit Grant Wistrom or Jason Peter or anybody else on that defense. I mean, I wanted to see the sacks, okay? I wanted to see the domination. And Danny Warfel, he paid the price. So it's the same thing with your financial plan. You need to make sure they have the best players on the field. So you want to make sure that from an offensive standpoint, we have a good growth strategy. Defense, we want to make sure that we have not only avoiding major losses, but also the tax and the estate, not tying that all together. That's what we do here at Stonebridge to help you.
Here's the number, 866-295-5146, 866-295-5146.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
So glad to have you back here on the show, Retirement Compass Radio Show with Stonebridge Wealth Systems. Tim Kulhanek in the Lincoln office, and Jeff Gove in the not quite all the way decorated, but we love you anyways, Jeff Gove in the Kearney office. You poor thing. Now the studio is beautiful, by the way. Studio is absolutely gorgeous. You have that nice under counter lighting and a nice setup. People can have a look for yourself on the YouTube channel if you want to. Stonebridge Wealth Systems on YouTube. We also publish a little podcast every single week, and you can find that wherever you find your podcasts. And it is called The Retirement Compass. And let's see, what else do we need to promote? Oh, if you do go to YouTube, we're going to have a QR code for you so you can understand how much tax you're going to be paying, because tax planning and strategies is a huge thing at Stonebridge and for you in your retirement. So you'll be able to point your phone right at the screen and bring, it'll come right up onto the stonebridgetaxbill.com. How about that sound effect?
Yeah.
Have a better one? That's what I meant.
Yeah,
Bring.
you did pretty good.
Okay,
so
thanks.
One quick thing on that, stonebridgetaxbill.com. Here's why you need to do that today.
Okay.
So there's a lot of conversation right now about tax rates and brackets, and are they going to go up, going to go down, stay the same? And some people might be under the mistaken belief that if the current tax rate system, if you will, specifically the 2017 Tax Cuts and Jobs Act, if those rates brackets get extended and made quote unquote permanent, that hey, we're good to go. There's nothing to worry about here. We're going to be in good shape. And I think that the reason that that's a mistaken belief is because the reality is nothing is permanent in Washington, A. B, eventually there's this big brick wall called reality that is going to hit, and it's got a 4-letter word written on it. And so I don't know about the TOS on YouTube, if they're going to allow this, but it's MATH.
MATH.
It's math.
Okay.
Math, folks, math. Math is going to rear its wonderful, beautiful face and say, you know what? Eventually you run out of money. And so basically what's happening right now is the U.S. is spending more on debt service, so interest payments, than they are on national defense. We spend an insane amount on national defense. It's close to $1 trillion, but we're spending this year, and this fiscal year we'll spend like $1.1 trillion, $1.2 trillion, something like that, on interest alone.
Oh, dear.
And the
Servicing
national
the
debt,
debt, yeah.
according to a lot of experts, assuming that the current system stays in place, national debt is expected to balloon from 37 to 38 trillion as it is right now to around $60 trillion by 2035. And so you think about the debt service, well, now you're talking about $2 trillion or close to it, depending on what rates do, just to pay the interest on the debt. Well, what did the government bring in last fiscal year? Most of the income, the revenue the government brings in, comes from individual income taxes, okay? So it could be from individuals paying income tax, from the FICA tax, so like Medicare, Social Security tax, that sort of thing. That's the majority of the revenue. And there's also obviously corporate income tax. There's different fees and surcharges, things like gas tax, things like Medicare premiums, things like the income-related monthly adjustment amount, or IRMA, capital gains tax, stuff like that. So there are other taxes and revenue streams. But it was about $4.1 trillion. And then they spent $0.8 trillion or $800 billion on debt service. They brought in $4.9 trillion. Let me take a step back. They brought in $4.9 trillion. They spent $4.1 trillion on mandatory programs. So that'd be like Social Security, Medicare, Medicaid, and like government pensions and that sort of thing. Military pensions, that sort of thing. Okay. Not the military. I'm talking about retirees. Okay. That's mandatory spending. It's important to understand, folks, that any bill like this one big beautiful bill act that they're talking about passing, it doesn't impact those programs at all. That would take a actual change in law in order to alter how Social Security and Medicare function. Okay, and that's going to be 60 vote majority in the Senate. So it's a much higher threshold than what they're using right now, which is called reconciliation, which they only need a 50 vote majority in order to get passed. Now, why is this all really, really critical, and why am I even spending time on it? Because if they bring in $4.9 trillion and they spend $4.1 trillion on mandatory programs alone, almost the entire budget is already consumed before we spend $1 on anything else, including the military, Department of Defense, Department of Education, Department of Commerce, Department of Energy. Right? Any of those other three-letter agencies, the FBI, the DEA, you fill it in, lots of them. There's no money because we spent 4.1 on the mandatory programs. We spent 0.8 on the interest or debt service alone. So all 4.9 trillion was accounted for before we had a single dollar spent elsewhere. So why is this important? Back to that. It's because it's great to think that the government's going to give us something for nothing, right? That you can kind of have your cake and eat it too. You can get tax breaks and no substantial cuts to spending because the government continues to spend more and more and more. That's just not reality. So eventually, in our opinion here at Stonebridge, tax rates will have to adjust, and they'll probably have to adjust substantially higher. And if you think about where we're at right now, the government separates Americans into quintiles when it comes to income. You got the upper quintile. That's where people like Jeff and his yachts and Malibu and stuff, that's where they're at, right?
Quintile.
It's not. It's where Jackie is, our radio host here.
Quintile. I don't even know the meaning of the word.
Do you have any idea how much they pay this woman? It's
big bucks.
Big bucks.
Oh my gosh.
So you got the upper quintile, so like the top, 10% of earners, top 20% of earners, I guess would be, top 40, 60, 80 in the bottom, right? So the middle quintile, you could look at the top income tax bracket, and it's 37% right now. It used to be 39.6. But let's just look at what are middle income earners paying. What's their effective marginal rate right now in America? And what has it been historically? Right now, the effective marginal rate for that middle quintile, so middle income earners, which is where most people are going to fall, right? If you think like the bell curve, right?
Yes.
It's 22%. What do you guys think it was for middle income earners in 2000? So Y2K.
You're trying to trick us.
No, I'm not. It's 22% right now. Jeff, what was it in 2000, 25 years ago?
I don't know.
Come on.
What was it in 2000?
Where'd Jeff go? Oh, there he is.
12%?
28%.
Oh, it's higher than
30% higher. So we're paying 30% less today than we were 25 years ago, and we've grown government substantially. So we're underpaying for the government we have. So my point is, when you hear Stonebridge, your advisor at Stonebridge, you hear Jeff, you hear myself, you hear Jeremy, Scott, Eli, Dano, Zach, Elisa. Can I name them all? Kelly?
Yeah.
Who am I missing? Scott? Did I get Scott?
We had him last week.
Yeah, we had him last week. Sorry about that, guys.
Don't say it like you're so disappointed, Jackie. Jeez.
Well, we had him last week.
But
Twisting
Tim,
my
the other thing,
words.
I mean, if we distill this down to like why you should call today,
Okay.
like we just look at the controllables, because you're right. Tax rates we think are going up, but we don't know, right? They might go up. Are they going to stay the same? I don't know. But one thing I do know is every year you wait, you're missing an opportunity, because you're getting 1 year closer to the day where you have to start drawing money out of these accounts. Then everything changes. Not that it's not an opportunity anymore, but now somebody else has a little bit more control, because the government's saying you have to start drawing money out of these accounts.
Yeah.
And we're going to tell you how much you have to. So, Kelly's just starting with us. She's gotten 2 text messages from her clients saying, man, I'm glad you joined Stonebridge. There's going to be so many more services you can offer. I've been listening to the radio show. And these are people we've never talked to. So if that's you out there, that you've been listening to the show for years and just not making that call, now is the time. If you wait another year, I want you to sit back and picture, where does that leave you? Are you still in the unknown? Because that's where a lot of us live if we're not making the phone call to find out, what does my picture look like? Go to stonebridgetaxbill.com, scan the QR code if you're on our YouTube page, and do it now, because you don't have to live in the unknown. We can move forward and put together a plan that's going to help you be successful.
Wonderful. Here's the number, 866-295-5146, 866-295-5146. That's really telling about the new advisor that you have. Is that because she's a gal? Why are they hearing that?
Why is she here? Well,
no, the clients are calling saying, wow, you're offering something I never heard before. What is that?
Well, I think it's just people that have listened to the show. She sent out a card to all of her existing clients, because she's been in the business, saying, hey, I'm joining the Stonebridge team. Oh. And they're excited. They're saying, yeah, that's awesome. We've been interested in Stonebridge. Again, we just haven't picked up the phone.
Oh.
I guess
Well,
my
I can
question is
appreciate
why?
like the loyalty, maybe because like, hey, we want to work with Kelly. Like, that's great. And so that, like, one of the reasons why we brought her on is, hey, we think this person is going to be excellent in this field.
Yes.
And let's like, it's kind of a win-win, right? Because she now has access to the scale that we're able to provide and the product suite that we have. So we have access to more of these planning tools when we're talking about things like taxes. So to me, it's kind of, it's encouraging for Jeff and I that, hey, our message is getting out. And it's encouraging that, hey, we brought someone on that's going to be really, really good.
Good. Plus, is it wrong to say that you brought a gal on? It's not bad, is it?
No, but we've got so we got Elisa as well, and Elisa just did a workshop the other night, and she did an excellent job, and so like it's a way to connect with I think an additional demographic of folks where when you're talking to ladies, especially ladies who maybe they've been through either divorce or they're widowed. And now they're like, hey, this is a new frontier. I need to navigate. Having someone that maybe has shared some life experiences with them that can help navigate them and kind of be their guide, I think is a great opportunity. And that's what we're trying to provide.
Great. 866-295-5146. Call Stonebridge, 866-295-5146. You could also follow the QR code wherever you see us. Either on YouTube or also on the podcast information. If you follow the podcast, there'll be a QR code listed there as well. All right, we're coming right back. Don't leave us.
As Americans, we strive for better. From a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
Hey, welcome back to the show, Retirement Compass Radio Show with Stonebridge. Stonebridge Wealth Systems, you can see us on YouTube. The reason we keep mentioning that is because we just started the YouTube channel. Yay for us, yay for us. Yay for them, yay for us.
Yay.
Which is it?
Yay for everyone.
Yay for everyone.
Yep.
Jeff is a good diplomat having so many kids.
Got a gang of kids.
You
Tim's
do.
catching up, though.
I know.
We're doing it.
Tim. Oh, but they're just not old enough to be doing this type of negotiation,
Clearly.
are they? Yeah. Oh, my goodness. Now, Jeff, Tim, on this segment, what did you want to talk about? I forgot now. Oh, you wanted to talk about
There went
estate
our
planning?
4 minutes. We're done.
Yeah, I know.
We're going to move it back to estate planning. So
Estate planning. Thank
yeah.
you. Sorry.
When you have all these kids, you got to figure out your estate plan. So here's the thing. Jeff said something in the first segment that I thought was interesting. He said that, you know, we work with clients all over the country, and a lot of that has been kind of a migratory pattern type of thing, in the sense that you know, people lived in Nebraska and then they decided that they were going to you know, relocate for maybe leisure reasons, maybe for family, whatever it might be. A lot of them end up in states like Arizona, Texas, Florida. Not as many California, but you know, there are some out there. And so, what if they still own their property in Lincoln or in Kearney or anywhere in between? Like, what if they still own real estate, tangible assets here in Nebraska?
Yep.
And how does that apply to estate planning? I mentioned an LLC, and so here's what I think you need to know. So this specifically relates to the inheritance tax that we have in Nebraska. Nebraska is one of just a few states that has an inheritance tax. I think there might be 13 or 14 that either have a inheritance tax or a estate tax at the state level. So this is not federal estate tax. Most of us don't have to worry about that. This is inheritance tax. And it applies to 3 different classes. So class 1 would be like immediate relatives. So your kids would fall here. They get a $100,000 exemption amount, and then they pay 1% on anything over that. Distant or remote relatives, nieces, nephews, aunts, uncles would be $40,000 exemption, 11% over that.
Oh.
And then non-relatives, so everybody else would be $25,000 exemption, and then 15% over that. So it applies to basically everything, unless you use something like life insurance, which is an amazing tool from a tax planning perspective, because of the leverage it gives you. You put $1 in, you could get $2 or $3 out, maybe more, maybe way more than that actually. And it's tax-free. As long as it's not, the beneficiary isn't the estate and it goes to named individuals, they won't actually pay inheritance tax on what they receive from life insurance. But here's where I came up with that LLC idea, is that if you move, when you move, then your non-tangible type of assets, so like your retirement accounts and that sort of thing, that's going to be technically located or have tax situs, as they call it, in the state that you have moved to. So your home state in that situation. But your tangible property still remains tax situs in Nebraska. So your beneficiaries would still have to pay inheritance tax. And if this is a farm, for example, or you know, you had a bunch of rentals or something like that, then that could be problematic, because then you're going to have, you know, if it's $1 million and you have 2 kids, they each get $500,000. $100,000 free and clear, but then they're going to pay 1% on that $400,000. Now, some people might hear that and say, oh, that's not too bad. Well, you know what? There's plenty of people we meet with who are leaving resources to nieces and nephews, and now it's like, oh, it's 11% over $40,000. So on, you know, $460,000, they're paying 11%. And so one of the things you can do is use an LLC, for example. It's a limited liability company to hold legal title to the real estate in Nebraska. And by doing that, the real estate's no longer directly owned by you. You own the LLC. So the LLC holds the real estate. You are left with basically an intangible property interest in the company itself, the limited liability company, which should not be subject to Nebraska inheritance tax. So a little bit of tidbit there, but those are the types of strategies that if you haven't heard that from your advisor, if you have one, or if you don't have an advisor and you're like, holy cow, like I do have real estate in Nebraska, I need a strategy to mitigate the tax implications, absolutely be a reason to give us a call.
866-295-5146, 866-295-5146. Do it now. Do it today.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Yes, it's a financial program you're listening to, Retirement Compass Radio Show with Stonebridge Wealth Systems. I'm Jackie. I've got Jeff and Tim. They're the experts. I'm just trying to keep this thing on the rails. It's just not easy some days. But we have been talking about taxes. Now, fellas, the importance of someone going to stonebridgetaxbill.com is to understand how much their retirement savings is going to be taxed if it's in a 401k or an IRA. Or in general, is before it's done, used in another vehicle, right?
Yeah.
Okay.
Yeah. So basically what I want people to do when they go there is they're going to look at the two different sides. So it's almost like if you think about going to the eye doctor and they're going to say, okay, 1 or 2.
Oh, my gosh.
Look about the same. Okay. Now,
I always say that. I
2,
can't tell the
right?
difference.
But the left side might be like, so let's say you're looking at the left, it's like a T, right? So T chart, and you've got the government's plan on one side, and you've got repositioning or like an alternative strategy on the other, right? So the one side is you just use the government's plan, which is basically just keep going the way you're going, take your RMDs and pay whatever tax, defer. That's the tax deferred paradigm. And that's what I call the optional tax bill. The mandatory tax bill is going to be, hey, there's a minimum amount you're going to pay. When we're talking about things like repositioning resources through things like Roth conversions, so you can prepay the tax bill. Some people hear prepay the tax bill, and they're like, oh, why would I prepay? Well, because you're going to pay one way or the other, and the only thing that matters is the rate. The optional is like, hey, do you want to volunteer and pay more? So it might say, let's say you input the data, and it says, all right, well, you've got $1.25 million in retirement accounts. You're estimating a 5% growth rate, and your effective rate is going to be 25% between federal and state. They're like, okay, well, here's your mandatory tax bill. If you're going to be at 25%, you're going to pay at least this. Right? So in other words, if it was $1 million, it'd be $250,000. You're going to pay this because you chose to put money into a pre-tax account at some point in time. Tax deferred, very the nature of the word, means later. So you're deferring your salary until a later point. So you'll pay the $250. I can't change that. The optional side is going to be like, hey, you know what? If you don't want to do anything, you don't want to take action to change your circumstances to better serve your purposes, because really that's what it comes down to, right? There's two types of the people of the world. There's those who just kind of fly by the seat of their pants that go through life as a passenger and whatever happens, laissez-faire. And then there's those that say, no, I'm going to change my circumstances to better serve my purposes so I can have a more enjoyable retirement. Well, if you choose not to take action because you're making a choice one way or the other, you're going to have those optional taxes, which could go from $250 to like $750, $1 million. I mean, it's shocking once you see over a 30-year period the compounding of the amount of taxes you'll pay, because you don't just pay taxes on the distribution. You might have what we call surcharges or IRMAs, income-related monthly adjustment amounts. You might have net investment income tax. So in other words, that's once you go over a certain threshold, you have to pay more on interest, dividends, capital gains, that sort of thing. And one thing I want to mention here real quick that doesn't even, this report doesn't even capture. We're trying to be nice about it, but this report doesn't even capture. Do you two want to guess? So are you familiar with IRMA?
She's a nice lady.
She's decent, yeah. So Jeff, IRMA's income-related monthly adjustment amount. Is it the same every year?
Nope.
So it goes up?
It does go up.
What does it go up based off of?
I don't know. Is it cost of living adjustments?
No, that's really important. That's where it's going with this. So in 2024, government puts out their report for Social Security, and they say, hey, by 2034, we're out of money in the trust fund, 75 cents on the dollar. Medicare puts out their report, and they say Medicare Part A has less than 10 years in the trust fund, and then we don't know what we're going to do. We won't be able to cover all of our claims. And Part A is hospital insurance. For Part B and Part D, they said, looks good, 10 years and beyond. We're fully funded. Why would they say that?
Because they're smaller programs.
It's one reason. Why else?
All right.
Any guesses, Jeff? No?
Irma? Is that the
You're right.
answer?
Yeah, you're on the right track. So here's because they're funded by premiums, and in like the addendum of the document, it says, well, the reason that we are saying that these are fine is because we're just going to jack the rates up because we have completely discretion on how much these rates go. They're not linked to a cost of living adjustment at all. And since 2019, the IRMA has increased every year on average by 7%. Now, we haven't had 7% annualized inflation for the last 6 years. It's been high, but it hasn't been 7% according to the CPIU. So it literally is a discretionary thing that the Social Security Administration can go in there and just say, you know what, we're going to raise Part B premiums by this much, Part D by this much, and we're going to raise those surcharges by 8%, 12%, 15%. They have complete discretion. That's why the report says that it's fully funded, is because it's funded by you. So if you want to avoid paying those IRMAs, it's another reason to go to that report, stonebridgetaxbill.com, go to that calculator, find out what your optional taxes are, and then when you come into our office, we're going to run an additional report called Roth Done Right that's going to show you the impact those IRMAs could have specifically and why you may want to consider getting all the heavy lifting done like sooner rather than later and in a shorter time period rather than defer and end up paying potentially compounding 7% per year more for those IRMAs at some point in the future.
Right, very good. 866-295-5146. Call Stonebridge, 866-295-5146. And if you prefer, just to go to the website, stonebridgetaxbill.com. That's the landing page for this report that we're talking about, stonebridgetaxbill.com. Or you could use the QR code associated with the Retirement Compass on YouTube or on wherever you get your Spotify, wherever you get your podcasts. Now, that is started out as not a very feel-good segment because the amount of taxes, Mr. Gove, that one is subject to in retirement just makes you want to be an ostrich and put your head in the sand.
Yeah, when I think the important thing is, you know, when we look at if you call in, we look at you. You're the hero in your story, right?
All right.
So what you need, though, is you need a guide that's going to help you walk through some of these things. So don't hear, again, everything that we're talking about with taxes and think, okay, I'm just going to go home and do Roth conversions. There's a gentleman in Omaha that came into the office. He had about $3 million in IRAs, tax-deferred accounts, and his financial advisor had him converting $10,000 a year. On a $3 million account, Jackie, do you think is $10,000, is that making any impact at all?
Well, no, it'd take a whole long time to get that done.
Well, I mean, if it's invested, he'll never get it done, right? I mean, if unless it's just sitting in cash, not earning anything, his interest is going to be hopefully way more than $10,000. When we did the analysis, he should be converting. It was like $130,000 a year, is what he should be converting, and so we got that updated. But again, it's important to have a guide that's going to look at your specific tax situation because everybody's situation is different. If you're married, if you're single, if you're drawing Social Security, if you're not drawing Social Security, if you don't have a Social Security plan, if you have a Social Security plan, like all of these things impact how taxes work. So it's, like I said, let us be your guide. You know, you don't have to do this alone. We can put together a plan that allows you to pay as little. Don't pay those optional taxes Tim was talking about. I mean, who's going to option into paying taxes? I know when we do tax workshops, you know, you can, for people that think we should pay higher taxes, you can actually volunteer to pay more if you want to, but I've never met anyone that wants to do that. So even the people that think taxes should go up, you know, they're not willing to write that extra check. Well, if you don't make a plan, that's essentially what you're doing. You're saying, I'm willing to write that check to pay extra taxes today. because I don't want to take the time to figure out what I should do.
Gosh, don't you think the IRS would fall over dead if you're talking to them on the phone and you said, I want to write an extra check? You'd hear the guy just fall over dead. Or they'd just send that extra check back to you, wouldn't they? I don't know. But you don't want your IRA to be an IOU to the IRS. You need to get a plan together and talk to Stonebridge. All right, 866-295-5146. We encourage always to sit down in person with the team because it's a nice, fun visit, and you'll get a good overview, and they'll find out what it is that makes you tick and how you want to be in retirement, what you want to do in retirement, and how you want to accomplish that. And they can help you strategize the taxes and all of it. They're a fiduciary firm. So that means they have a high level of responsibility towards you, the highest level. They have to operate in your interest. You guys do that. You don't operate in the interest of whatever it is. I don't know, if you go to a brokerage, they're going to be taking fees out of your money every month. But you guys have transparency and people can trust. But it all starts with sitting down with a little visit. Or, again, go to stonebridgetaxbill.com if that's what you'd like to do. 866-295-5146, 866-295-5146.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Retirement Compass Radio Show with Stonebridge Wealth Systems, Stonebridge Wealth Systems on YouTube. If you'd like to watch us present this show, tell your friends about it, and you can find the Retirement Compass anywhere you find your podcast, or just listen here on the radio. We appreciate you. Phone number to reach out, 866-295-5146. That's probably the best way, only because then you can book your little visit. 866-295-5146. Okay, fellas, we have some scenarios to run through. Everybody ready, strapped in, ready to go?
Let's do it.
All right, looks like it. Okay, Mr. Gove, with both Social Security and a pension income kicking in, folks could be worried that retirement distributions will push them into that higher tax bracket at 73 years old. What is the strategy that can help smooth out their taxable income before the RMD hit? Do you want to go over it again?
Sure. Yeah, I feel like we've talked about that, this whole show.
The whole show, I know, but
let's run through it. So when you're drawing Social Security, I guess when we do a Social Security workshop, we talk about, one question I always ask is, who thinks Social Security should be taxable? And believe it or not, nobody raises their hand.
No.
Who thinks it's 100% taxable? People raise their hand. And the fact of the matter is, some people don't pay any tax on their Social Security. Some people do. Up to 85% of your Social Security can be taxable. But all of your other income, your pension that you mentioned in this scenario, that will impact how Social Security, how and if Social Security will be taxed. That's why doing these Roth conversions is really important before you get to that point, if you can. But if not, it still makes sense. But we may want to limit how much we do, because if there's a chance that if you take $1 out of your IRA, you could be paying tax on $1.85, if you're also paying tax on your Social Security. So you have to be really careful with that. And that's why, I've said multiple times, I don't want you to hear this information and go home and just do massive Roth conversions without knowing the impact. We have the software where we can plug all of this stuff in and tell you and show you how much you should do based on your income. But if you wait, the question is, before RMDs hit. So let's talk about after RMDs hit. So if we don't do anything before RMDs, there are still options after RMDs. Oh. So you can do qualified charitable distribution. So if you say, I don't need this money, I'm going to send it to a charity. If it goes directly to a charity, it satisfies that required distribution and you don't have to pay tax on it. And there's some other things, and Tim, I'll let you touch on it, but where you have to make sure you do the QCD, because if you're a farmer and you're taking, if you're itemizing, there still could potentially be problems. Tim, do you want to touch on that?
Yeah, I mean, with QCDs, there's a few different things that I think need to be talked about. The first is starting this year, they're going to have a new code that's going to go on the 1099 that's going to inform the taxpayer, preparer, and the IRS that a QCD was completed. So QCD, qualified charitable distribution, like Jeff said, it has to be done by December 31st, and it has to go direct from your IRA to the charitable organization. You can't do a QCD from a 401k, a TSP. So a lot of people hear about these. Again, this isn't a reason why the DIY approach rarely works out. I mean, you could try it if you want to, but the data is what the data is, and that is that people who work with financial advisors on average will earn about 3% more per year. And that's not necessarily because they're making more. A lot of it has to do with because they're keeping more because they understand the nuances of these rules. So you can't do a QCD from a 401k. It's only from an IRA. Okay, so that'd be a reason why, hey, you know what, if I'm going to do QCDs, I need to do a 401k rollover or consider that. Itemizing hasn't worked out as like not only 7% roughly of the American public itemize. So not many people are actually itemizing their return. And the reality is, even if you were going to itemize on a Schedule A, here's what happens. If you're married filing jointly and you're 65 plus, both of you, you're going to get $33,200 of a standard deduction. And so if you gave, let's say, $30,000 to charity, and then your state and local tax and your other itemizations add up to, let's say, another $10,000, you get a $40,000 standard deduction, okay? That also means that you took the distribution yourself and then you turn around and gave it to charity, and so it hits your AGI, which means it adds to your modified adjusted gross income, which means it counts towards income-related monthly adjustment amounts. It counts towards the net investment income tax. So, it's not as simple as you would think. So this is where advisors, especially holistic planners like Jeff and I on our team at Stonebridge are, where we're thinking outside the box. We're looking outside of just, the expense ratio on this fund is 67 basis points and this one's 30 and they have similar performance. Let's go with yes, we do that. We want to minimize fees, but this has way bigger impact because if I do a QCD instead and it was a $30,000 QCD, I'm basically having my cake and eating it too, because I'm not only getting the $33,200 standard deduction, I'm getting the credit for the $30,000 because I don't have to take an RMD of $30,000 because that QCD counts towards it. I keep it off of my AGI, which means I keep it off of my MAGI, modified adjusted gross income, which means it doesn't count towards IRMA. It also doesn't count towards the net investment income tax. And at the end of the day, I might be saving, depending on the scale, tens of thousands of dollars over a very short period of time in taxes alone because I just used a better plan. Now, the thing that's been confusing about years past, and unfortunately what's happened for a lot of folks, is they did QCDs and they never got credit for it. In fact, worse, they paid tax on the money that they never got to use because they did the QCD, but until 2025 taxes done in 26, your 1099s, all it did was say, hey, you took this amount out. And so, I had a client in the other day, Jeff, and he's still... he's trying to put off the fact that he probably is at the point where he needs to hire a professional to help with different aspects of finance. And I've referred him to our friend Greg a few different times. Well, I told him I would like to see your tax return. And sometimes people will be like, no, you don't need to see my tax return. I'll just tell you how much my adjusted gross income was. I said, no, I want to see your tax return. Well, why? And I said, a lot of reasons. I just need to see the return, okay? So I looked at the return, and here's what I found. He took $8,750 out last year as a QCD. It went directly to 3 different charities, okay? His 1099 just said in box 1, distribution, $8,750, taxable amount, $8,750, and then there's a little box that's checked that says taxable amount could not be determined. But he doesn't have a tax preparer. He uses TurboTax, so there's nobody there to catch it. And so what do you think he did? He was just trying to follow the rules, so he put it there on his return. He paid tax on the $8,750 that went to the charitable organization that he never should have paid taxes to. That cost him $2,400, you guys, in tax that he didn't need to pay. I'm talking about on $8,000, let's call it $9,000.
Oh, dear.
So take that times 3. right? Now, this is where I say this is tens of thousands of dollars in a very short period of time. This is the work that Jeff and I and our team are doing. And this is why you should be working with somebody who's a holistic planner, who's looking at more than just, hey, you got 7. I think I can get you 8. I don't care if you can get 8 until after I know how much of that 8 you get to keep.
That is, oh boy, 866. Oh boy, 866-295-5146, 866-295-5146. Call Stonebridge. Oh my gosh. My heart just goes out to that person, 866-295-5146. It is complicated, complex, and you really need some professional eyeballs on the situation, 866-295-5146. Okay, how about this one? $300,000 in after-tax investments, and folks thinking about earmarking it for future healthcare needs. Okay, $300,000 in after-tax investments, thinking about earmarking it for future healthcare needs, but they're not sure if it's better to invest it or buy a hybrid long-term care policy. What are the trade-offs? Go, Jeff.
Oh, okay. So, yeah, I would need a little bit more information, but
Okay.
First off, you could potentially do both. I mean, there's hybrid life policies where you could put that $300,000 in there, potentially still have access to that $300,000, potentially have it multiplied for a long-term care event and for death benefits. So there are a lot of options. Mm-hmm. If I'd want to know what other assets you have, and we need to put together a whole plan to make sure that you're okay, because I don't want to plan for the day that no one wants to come in a manner where you sacrifice everything that you want to do in the good years. So we want to make sure you have a plan to do the things that you want to do. And if you have money left over, then we want to plan for, again, that day that no one wants to come. So could be a lot of different things to do with that money, but doing a hybrid life with long-term care could be a good option.
Mm-hmm. That's an interesting way to put it. 866-295-5146 to call the team at Stonebridge, 866-295-5146. Because we've done shows on this before, haven't we, Tim, where people are afraid to use the money in a distribution form because they're so worried about later that they don't use the money for now.
Yeah, I think we've talked about things like the guaranteed income license to spend. That was a article
license to spend. Thank you.
We spent a lot of time on, and I still I was reading just the other day. This is going to seem totally made up to most people. I was reading the executive summary of the National Institute of Retirement Security 2024 Retirement and Security report, and it was Americans' views on retirement. But here's what the takeaways are. So they asked Americans, they said, describe the ways in which your vision of retirement has changed. Quote, I am scared to be broke. They said, describe the ways in which your vision for retirement has changed to another person. They said, expenses have accrued so rapidly. I once contributed to a hefty amount into my 401k for my age. I now have $0 in my budget to contribute. Since inflation has become more problematic, it's gotten really difficult to see myself retiring when I had planned. I've had a hard time adding to my 401k since I am losing money. I'm really worried about the future. But that same report found that 77% of Americans agree that those with pensions are more likely to have a secure retirement. What is that? And the problem is pensions have kind of gone the way of the dinosaur. What does that tell us? It tells us that we need to be focusing on guaranteed income as a portion of a plan. Don't hear the wrong thing. Don't hear what I'm not saying. I'm not saying put all of your money in a specific whiz-bang product. What I'm saying is you need a comprehensive strategy, and Stonebridge is the place that you can get that.
866-295-5146, 866-295-5146. Retirement Compass radio show is a wrap for this week. Blah, 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 blah. Oh, that was it. Oh, here's the music. Good.